Welcome to the ETF.com Spotlight Series. I'm your host, Ugo Egbunike, Director of Business Development here at ETF.com. Today I'm joined with Eric Pollackov, the Managing Director of the ETF Capital Markets Group at Charles Schwab. Eric, thanks for joining me.
Thanks for having me.
So Schwab, obviously a large brokerage, huge client base. Can you talk to us about sort of the adoption of ETFs by advisors on your platform and the sort of growth that you're seeing there?
Sure. What we've experienced over the past few years is approximately 85% of the advisors on our platform are using ETFs to some extent, have touched it, have bought it, have sold it. What we also kind of focus in on is also the retail space. And as you know, as one of the larger custodian of assets here at Charles Schwab, it's only 1 in 5 of the retail client base has actually touched an ETF. So again, I think there's a huge amount of growth for us within the retail space, but again, the advisor community, like everybody else, needs to be educated on what the new products are and how those things work and how to best execute, et cetera.
So with that growing demand, how are advisors using ETFs? Are there particular funds or strategies that you see increased demand for, or particular beta strategies that they start to look at?
If we just look at last year alone, right, the S&P is up almost 30% or just around 30%. So equity fund flows. So for almost 2/3 of the flows that we saw on our platform went into some type of equity, right, which makes sort of sense. Commodities got hurt, right, because of the lack of demand and the pricing pressures for that asset class. And then if you look at just the fixed income space, right, people kind of tried to get to the shorter end of the curve, and whether it was with bank loans or near-term type products, as opposed to eliminating the longer-term treasury interest rate more sensitive type products. That's where we kind of saw the asset growth. Now, but advisors, they're becoming more unique with their usage of ETFs because of just the fact that there's more asset classes that are now being covered with the ETF structure. And if you think about the ETF at its very heart, it's really democratized asset classes, right? It's actually made access to platinum or palladium or agriculture, type commodity futures, et cetera, more accessible to the average client. So again, I think it's really usage is just more about where they can actually find access to these new asset classes.
Okay, so looking back at 2013, it's interesting that you said that, but you guys actually launched 6 ETFs based on fundamental index strategies.
Right.
How had advisors taken a liking to that, and what was the driving factor behind that decision?
We had launched our index, fundamental index mutual funds, and there's over $5 billion in those types of products. And what we wanted to do is make sure that we can offer vanilla in either a cup or a cone, so to speak. So we came out with the ETF structure. We launched those in August, and really kind of thinking about breaking that market price valuation of a stock within an index, and thinking about other factors of how to evaluate a company, such as price to earnings or sales, adjusted sales, et cetera. So those types of factors now, we look at them as more of a complementary type of product as opposed to an or product. It's more of like and is the way we kind of think about it, because you combine the usage of both the market cap space as well as the fundamental space to kind of get the beta that you're looking for.
So if these are strategies that are supposed to be more of an and, like you said, how should advisors really think about evaluating these new strategies?
Yeah, I mean, it's like anything, and whether it's a fundamentally weighted product, a commodity future-based product, a physically backed, it doesn't matter. It's what do you own? What is the index designed to do, or the active manager if we're talking there. But if we're looking at just index-based passively managed products, is how are they constructed? Right? And how often are they rebalancing? How's the portfolio manager doing? Are they fully replicating? Are they optimizing? Those types of basic kind of know what you own strategies and thought processes need to be done by any advisor, by any retail client, by anything. And again, this is not just about ETFs. This is about mutual funds, closed-end funds, stocks, anything. You don't just buy something just because it says large cap or Twitter or something like that.
So let's talk a little bit about cost. You guys made a huge splash when it came to entering the ETF market, and your expense ratios, and you are the lowest in your Lipper categories. Is that really the main driving factor when advisors are looking at ETFs and evaluating their strategies?
Well, I think it's one of the overall factors, right? We're all aware of expense ratios is a cost. We're all around commissions is a cost. As a custodial platform, we can control that, and as a manufacturer of ETFs, we can control expense ratios. And then there's also bid-ask spreads, right? So it's thinking about all of those costs overall, and then we didn't even talk about tracking error, right? Which is an implicit cost, right? So I think it's not the only factor. But it's clearly one of the main drivers around performance differences, right? If you think about the same exact strategy, one that charges 95 basis points and one that charges 5 basis points, right? You're clearly going to be behind immediately 90 basis points in terms of performance. So I think what we're trying to do philosophically here is make sure that our strategies are at the most cost-effective solution for our clients and for any client that wants to invest in them, because again, they're traded on exchange and anybody can buy them. But I think if you philosophically understand what Schwab's been about for the past 40 years, it's always about driving costs down, because that increases your overall performance.
So going into that a little bit more and sort of what factors advisors are using, it's becoming apparent that despite the fact that ETFs have taken off and we've seen massive asset growth, this is just the early stages of the product. And a key factor in driving that is the education of advisors. What are you guys doing on your end to make sure that advisors are educated, and what sort of services are you providing around that?
So there's a couple of things. So for me personally is I put together what we call ETF roundtables, and we've got advisors on our platform. We get them over a lunch discussion or a dinner discussion, and we talk about the ecosphere that is ETFs, right? And that's a huge umbrella, right? ETPs, ETNs, ETCs, all these types of tax differential treatments, tradabilities, how to best execute. All these factors need to be discussed. Outside of that, from an educational standpoint, we've got Schwab ETF Educational Exchange, which is where we put third-party content from all of our all the providers in the industry, where we can centralize instead of going to specific ETF issuers' websites and pulling down information. You can go to one website and you can actually access third-party content, including our own as well. But again, it's trying to just make sure that we're being as educational as possible to as many of our clients as possible. And again, it's not always easy, right? And so there's these different types of webinars that we do for our own clients, investment outlook seminars that we do for our clients, and then there's always just direct conversations with our clients.
And then there is the capital markets desk, which you run.
Yes. So from our perspective, if an advisor on our platform has a question about any liquidity, whether it's our proprietary products or any others, there's access for them to talk to an agency-only representative at Schwab that we work with liquidity providers to make sure they're getting the best execution and the best price. And that's an important step, right? Because you do all this due diligence as an advisor, and you sift through these 1,500 products, and I've got this one ETF that I want to buy. And if you don't do the execution properly, you're going to be behind the index, or in this instance, I always talk about passively managed index-based products. You're going to be behind the performance immediately, not a week from now, not a year from now. So again, what we do is we work with liquidity providers to make sure that our clients are getting the best execution.
I think the key is what you mentioned there. It's on an agency-only basis.
Yeah.
So switching gears, looking forward to 2014, what are some of the new things that you guys are seeing in the space on your end, and how are you adapting to that?
Yeah, again, as we see this proliferation of products, it's our job as a custodial and a trading platforms to make sure that we understand what I don't want to call them competitors, because we don't compete with everybody out there and over the 50 issuers that are here in the United States, but it's our job to understand how those products are behaving, what they're doing, to be able to translate to our clientele, right? So that's really kind of the things that we think about and we focus in on, is just really discussing the new types of products out there and make sure that we're educating people properly about that.
Great. Well, that's all the time that we have for today's show. Eric, thank you so much for joining me.
Thanks, Hugo.
And folks, if you want more information, go to www.schwabetfs.com. Of course, tune in next time to the ETF Spotlight series.